If you are over 60 years old and worried about running out of money in retirement, what I am about to share with you could be the most important financial information you ever receive. I have spent over 7 decades studying money, investing, and wealth preservation. I bought my first stock back in 1942 when I was just 11 years old, and I have been obsessed with understanding how wealth is created and preserved ever since. I have watched countless people approach retirement with fear and uncertainty, not knowing whether their savings will last or whether they will end up dependent on others in their final years. And I have developed a simple 3-step plan that virtually guarantees you will never run out of money if you follow it faithfully. Now, I know that sounds like a bold claim. Never running out of money sounds too good to be true. In a world full of financial charlatans promising impossible returns and guaranteed riches, you have every right to be skeptical. But the mathematics behind this plan are rock solid. The principles have been tested through every market condition imaginable, through recessions and depressions, through wars and panics, through inflation and deflation, through the dot-com crash and the financial crisis and the pandemic sell-off. This is not speculation or theory. This is a proven approach that has worked for generations of retirees and will work for you too if you have the discipline to implement it. Let me start by telling you why this matters so much and why most people get retirement planning completely wrong. The mistakes I see people make with their retirement money keep me up at night because they are so avoidable and so devastating. The single greatest financial fear for Americans over 60 is running out of money before they die. Surveys consistently show that retirees are more afraid of depleting their savings than they are of death itself. Think about that for a moment. People would rather face mortality than face the prospect of being broke and dependent in their 80s or 90s. The fear of running out of money is more terrifying than the fear of dying. That tells you something profound about how deeply this anxiety runs. And that fear is not irrational. It reflects a very real risk that millions of Americans face every day. The statistics are sobering. Nearly half of Americans have less than $10,000 saved for retirement. Even among those who have saved diligently, many do not have enough to maintain their standard of living for a potentially long retirement. The combination of increasing lifespans, inadequate savings rates, and the shift from guaranteed pensions to uncertain 401k plans has created a retirement crisis that affects tens of millions of people. The average 65-year-old today has a life expectancy of roughly 20 more years. But averages can be deceiving and dangerous to rely on. If you are reasonably healthy at 65, if you do not smoke, if you maintain a healthy weight, if you stay physically active, you have a very good chance of living well into your 90s. Medical advances continue to extend lifespans every year. New treatments for cancer, heart disease, and other conditions are keeping people alive longer than ever before. A woman who reaches 65 today has nearly a 50% chance of living past 90. A man has about a 35% chance. And if you are a married couple, both age 65, there is close to a 70% chance that at least one of you will live past 90. That means your retirement savings may need to last 25 or 30 years or even longer. Let me say that again because the implications are staggering. 3 decades of withdrawals. 3 decades of inflation steadily eroding your purchasing power. 3 decades of market volatility testing your nerves and your portfolio. 3 decades of healthcare costs that seem to rise faster than anything else in the economy. 3 decades of uncertainty about whether your money will last. When you frame it that way, when you truly contemplate what a 30-year retirement requires financially, the fear of running out of money makes perfect sense. It is not neurotic or irrational. It is a reasonable response to a genuine risk. But here is what most people do not understand. The fear itself often leads to mistakes that make the feared outcome more likely, not less likely. People become so afraid of running out of money that they either spend too little and live unnecessarily meager lives, denying themselves simple pleasures and experiences that would enrich their retirement years, or they become paralyzed and make no decisions at all, leaving their money in inappropriate investments because they cannot face the anxiety of making changes. Or they fall prey to financial predators who promise safety and security while extracting enormous fees that steadily erode the very nest egg they are trying to protect. Fear is not a good financial advisor. Fear makes people irrational. Fear leads to poor decisions. I have seen retirees so afraid of running out of money that they refuse to spend on necessary health care, letting treatable conditions become serious because they cannot bring themselves to pay the deductible. I have seen retirees skip meals to save money when they have hundreds of thousands of dollars sitting in the bank. I have seen retirees refuse to visit grandchildren because they cannot justify the cost of a plane ticket. This fear-driven deprivation is not financially rational. It is a form of self-harm driven by anxiety rather than clear thinking. On the other end of the spectrum, I have seen retirees so paralyzed by fear that they leave all their money in cash, earning nothing, watching inflation slowly but surely destroy their purchasing power year after year. They feel safe because the number in their account is not going down, but they do not realize that the buying power of that number is declining every single day. They are becoming poor in real terms while feeling rich in nominal terms. And worst of all, I have seen retirees handed over to unscrupulous financial advisors and insurance salesmen who exploit their fear to sell expensive products that benefit the seller far more than the buyer. High commission annuities with surrender charges that trap money for a decade, expensive variable universal life insurance sold as an investment, hedge fund investments with enormous fees and mediocre performance. These predators specifically target fearful retirees because fearful people are easy to manipulate. What you need instead of fear is a clear, simple, mathematically sound plan that removes the uncertainty and gives you genuine confidence that your money will last. Not false confidence based on wishful thinking or slick sales pitches, but real confidence based on sound principles that have been tested through every kind of market environment over many decades. That is exactly what I am going to give you today. 3 steps, follow them faithfully, and you will never run out of money. Before I explain the 3 steps, let me tell you a story that illustrates why conventional retirement advice often fails. I knew a couple friends of friends who retired in 2000 with what they thought was a comfortable nest egg. They had accumulated about $1 million in their retirement accounts. Based on the conventional wisdom of the time, they planned to withdraw 4% per year or $40,000, supplemented by Social Security. Their financial advisor told them this was a safe withdrawal rate that would last 30 years with high probability. Then the dot-com crash happened. Their portfolio dropped 40% in the first 2 years of their retirement. Suddenly, their $1 million was $600,000, but they still needed to live, still needed to pay bills, still needed to withdraw money, so they kept taking their $40,000 per year. But now that $40,000 represented almost 7% of their reduced portfolio, not 4%. The market eventually recovered, but they had locked in losses by selling during the downturn. They had violated one of the fundamental principles of successful investing, which is never being forced to sell at the wrong time. Their portfolio never fully recovered because they had to keep withdrawing money throughout the bear market. By 2015, their savings were nearly exhausted. They were in their late 70s, in declining health, and essentially broke. They had to sell their home and move in with their daughter. The comfortable retirement they had planned turned into dependency and financial stress. This is not an unusual story. Millions of retirees have experienced some version of this tragedy. They did everything they were told to do. They saved diligently. They followed conventional advice. And they still ran out of money because the conventional advice failed to account for the reality of sequence of returns risk and the psychological pressure of withdrawing money during market downturns. The 3-step plan I am about to share with you is designed to prevent exactly this outcome. It is designed to give you income security regardless of what the market does. It is designed to let you sleep at night without worrying about whether the next crash will destroy your retirement. And it is simple enough that anyone can understand and implement it. Step 1 is what I call building your income floor. This is the foundation of everything else. And it is the step that most retirees either skip entirely or execute poorly. Without a solid income floor, everything else falls apart. Your income floor is the guaranteed income that will cover your essential expenses for life, no matter what happens in the stock market, no matter what happens in the economy, no matter what happens in the world. Let me be very specific about what I mean by essential expenses, because this distinction is absolutely critical to the entire strategy. Essential expenses are the costs you absolutely must pay to maintain a basic standard of living. These are not luxuries. These are not nice to haves. These are the fundamental costs of being alive and maintaining your dignity. Housing comes first, whether that is a mortgage payment if you still have one, rent if you are a renter, or property taxes and homeowners insurance if you own your home outright. Everyone needs a roof over their head, and that cost must be covered reliably. Utilities come next. Electricity to keep the lights on and the house heated or cooled, natural gas if you use it for heating, water and sewer, basic telephone service, or a cell phone for emergencies. Internet access, which has become essentially essential in modern life for everything from banking to healthcare to staying connected with family. Food and groceries. Not fancy restaurants or gourmet meals, but basic nutrition. The cost of keeping yourself fed with healthy food. This varies by location and personal preferences, but everyone needs to eat. Healthcare costs are increasingly important as you age. Medicare premiums are deducted from your Social Security check, but that is just the beginning. Most people need supplemental insurance, either a Medigap policy or Medicare Advantage, to fill the gaps in basic Medicare coverage. Prescription drug coverage through Part D or an Advantage plan, typical out-of-pocket expenses for doctor visits, lab work, specialist appointments, dental and vision care, which Medicare does not cover. These costs add up to hundreds of dollars per month for most retirees and can be much higher if you have chronic health conditions. Basic transportation. Unless you live in a city with excellent public transit, you probably need a car to get to doctor appointments, grocery stores, and other essential destinations. That means car payments if you do not own your vehicle outright, insurance, gas, and maintenance, and any debt payments you still carry. Hopefully you have minimized debt going into retirement, but if you still have a mortgage or car loan or other obligations, those payments are essential expenses until they are paid off. Add up all these essential expenses. Be thorough and honest with yourself. Write down every category and estimate realistic monthly costs. For most retirees in most parts of the country, this number is somewhere between $3,000 and $6,000 per month, depending on where you live, whether you own your home, and your specific health care needs. In expensive coastal cities, it might be higher. In lower cost rural areas, it might be lower. But the exercise of calculating your specific number is essential. Let us say for our purposes that your essential expenses total $4,000 per month or $48,000 per year. That is your income floor target. That is the amount of guaranteed, reliable, market-independent income you need to secure before doing anything else with your retirement planning. The income floor must come from sources that are guaranteed for life and not dependent on stock market performance. This is non-negotiable. If your essential expenses depend on stock market returns and the stock market crashes 50% in your first year of retirement, like it did for some people in 2008, you are in serious trouble. The income floor must be bulletproof. The most important source of guaranteed income for most Americans is Social Security. I cannot overstate how valuable Social Security is. It is the closest thing to a perfect retirement income source that exists in America. It is backed by the full faith and credit of the federal government. It adjusts for inflation every year through cost of living adjustments, so your benefit maintains purchasing power over time. It continues no matter how long you live, whether you die at 70 or live to 110. There is no other investment in the world that offers inflation-adjusted, government-guaranteed lifetime income. Social Security is unique and precious.
For most retirees, Social Security is the single largest source of retirement income, and properly optimizing your Social Security benefits is one of the highest value financial decisions you can make.
Yet most people get it wrong because they do not understand how the system works. One of the biggest mistakes people make with Social Security is claiming benefits too early. You become eligible to claim at age 62, and many people do claim as soon as they can. The logic seems reasonable. I have paid into this system my whole life. I want to get my money. Who knows if I will live long enough to make waiting worthwhile? Take the money now and enjoy it. But this logic is usually wrong, and the math proves it convincingly. If you claim at 62 you receive significantly reduced benefits compared to waiting until your full retirement age, which is 66 or 67 for most people alive today. And your benefits are further reduced compared to waiting until age 70. The difference is enormous, and most people do not realize how enormous. Benefits at age 70 can be 75% or more higher than benefits at 62. Let me put concrete numbers on this. If your benefit at 62 would be $1,500 per month, your benefit at 70 might be $2,600 per month or more. That is an extra $1,100 per month, every month, for the rest of your life. Over a 20 or 25-year retirement, that difference amounts to hundreds of thousands of dollars. And because Social Security is inflation adjusted, that higher base amount compounds in value over time. Each year, your benefit gets a cost of living increase. A higher base at 70 means higher absolute dollar increases from inflation adjustments compared to a lower base at 62. The gap between the early claimer and the late claimer actually widens over time, not narrows. If you are over 60 and have not yet claimed Social Security, I urge you to think very carefully about your claiming strategy. For most people in reasonable health, delaying Social Security as long as possible, ideally until age 70, is one of the best financial decisions they can make. Every year you delay between 62 and 70, your benefit increases by approximately 6 to 8%, depending on your specific full retirement age. Where else in the world can you get a guaranteed 6 to 8% annual return on an investment that is backed by the United States government, inflation adjusted for life? Nowhere. There is no investment, no bond, no annuity, no stock that offers that combination of return, safety, and inflation protection. Delaying Social Security is essentially buying more of the best investment available. It should be the default strategy for anyone who can afford to wait. Now let us do some math. Suppose delaying Social Security until 70 gives you a benefit of $3,000 per month. That covers 75% of your $48,000 annual essential expenses. You need another $12,000 per year, or $1,000 per month, to complete your income floor. This is where annuities come in, and I want to be very careful here because annuities are among the most misunderstood and often misused financial products available. Most annuities sold by insurance agents are expensive, complicated, and not in your best interest. Variable annuities with high fees, indexed annuities with confusing participation rates, deferred annuities with surrender charges that trap your money for years. These products primarily benefit the insurance companies and the agents who sell them, not the retirees who buy them. But there is one type of annuity that makes excellent sense for building your income floor. It is called a single premium immediate annuity, or SPIA. Here is how it works. You give an insurance company a lump sum of money. In return, they promise to pay you a fixed monthly income for the rest of your life, no matter how long you live. If you live to 105, they keep paying. If you die next year, they keep the remaining money. It is a simple exchange of a lump sum today for guaranteed income forever. The pricing of immediate annuities is actually quite favorable because insurance companies can pool longevity risk across thousands of policyholders. Some people die early and subsidize those who live long. The insurance company can invest the pool of premiums and earn returns that fund the payouts. As a result, the income you receive from an immediate annuity is typically higher than what you could safely generate from the same amount of money invested in bonds or other conservative investments. For our example, suppose you need an additional $1,000 per month or $12,000 per year to complete your income floor. At current rates, for someone in their mid-60s, you might need to invest approximately $150,000 to $200,000 in an immediate annuity to generate that income. The exact amount depends on your age, gender, and current interest rates, but the principle is the same. You exchange a lump sum for guaranteed lifetime income. Some people object to immediate annuities because if you die early, the insurance company keeps the remaining money. This is a valid concern, and there are solutions. You can purchase a period certain guarantee that ensures payments continue for a minimum number of years, say 10 or 20 years, even if you die early. Your heirs would receive the remaining payments. This costs slightly more, but provides peace of mind. You can also purchase a joint and survivor annuity that continues paying as long as either spouse is alive. This is essential for married couples where both partners need the income. The payments are slightly lower than a single life annuity, but the protection is critical. The key insight about step one is this. Once you have built your income floor, once you have guaranteed income from Social Security and possibly an immediate annuity that covers your essential expenses, you have eliminated the risk of running out of money for basic needs. No matter what the stock market does, no matter what happens to your other investments, you will always have enough to pay for housing, food, health care, and other necessities. You have created a financial foundation that cannot be destroyed. This is enormously liberating psychologically. The fear that keeps retirees awake at night, the fear of becoming destitute and dependent, is eliminated by a properly constructed income floor. You may not live a luxurious retirement if markets perform poorly, but you will never be broke. You will never be unable to pay your bills. You will never be forced to move in with your children or depend on charity. Step two is what I call the strategic reserve. This is the money you set aside for irregular expenses, emergencies, and most importantly, to provide crucial flexibility during the early years of retirement when you are most active and when something called sequence of returns risk is highest. Understanding and implementing the strategic reserve correctly can mean the difference between a successful retirement and a failed one. Let me explain sequence of returns risk because it is one of the most underappreciated dangers facing retirees. The order in which you experience investment returns matters enormously when you are withdrawing money from your portfolio. This is fundamentally different from the accumulation phase when you were saving for retirement. During your working years, the order of returns did not matter much. If you averaged 7% over 30 years, it did not really matter whether the good years came early or late. The final result was approximately the same. You could recover from early losses by continuing to save and invest through the recovery. But in retirement, everything changes. If you experience a major market crash in the first few years of retirement, when your portfolio is at its largest and your withdrawals are just beginning, the damage can be permanent and irreversible. You are forced to sell investments at depressed prices to generate income. Those sold shares can never recover because you no longer own them. Your portfolio is permanently smaller, and it may never catch up even if the market eventually recovers strongly. This is exactly what happened to the couple I told you about earlier who retired in 2000. The market crashed 40% in their first 2 years of retirement. They had to keep withdrawing money to live on. They sold at the worst possible time, and their portfolio never recovered. The strategic reserve is your defense against sequence of returns risk. By holding 2 to 3 years of expenses in safe, liquid investments, you create a buffer that allows you to avoid selling stocks during downturns. When the market crashes, you draw from your safe reserve instead. Your stocks stay invested and recover when the market rebounds. You are never a forced seller at the worst possible time. The strategic reserve should be held in safe, liquid investments that will not fluctuate with the stock market. I am talking about Treasury bills, which are backed by the full faith and credit of the United States government. Treasury notes with maturities of 2 years or less, money market funds that invest in government securities, certificates of deposit from FDIC insured banks, and possibly very short-term bond funds with minimal interest rate risk. These are not growth investments. They will not make you wealthy. Their purpose is entirely different. They provide stability when everything else is unstable. They provide liquidity when you need access to cash. They provide peace of mind when the stock market is crashing and the headlines are screaming about financial doom. How much should you hold in the strategic reserve? A good rule of thumb is 2 to 3 years of discretionary expenses plus a cushion for emergencies. Let me explain what I mean by discretionary expenses, because distinguishing between essential and discretionary expenses is crucial to this framework. Discretionary expenses are the costs beyond your essential survival needs. Your essential expenses are covered by your income floor, remember. Social Security and possibly an immediate annuity provide guaranteed income for housing, utilities, food, health care, and other necessities. The strategic reserve covers everything else. What falls into discretionary expenses? Travel and vacations, entertainment and dining out, gifts to children and grandchildren, including birthday presents and holiday gifts, and helping with major expenses like weddings or home down payments. Home improvements and repairs beyond basic maintenance, replacing your car when the old one wears out, Charitable contributions to causes you care about. Hobbies and recreation, whether that is golf or gardening or woodworking or whatever brings you joy. Club memberships. Subscriptions and streaming services. Add up your anticipated discretionary spending for a typical year. Be realistic about how you actually want to live in retirement, not some artificially frugal budget you would hate. If you plan to travel extensively, budget for that. If you want to help your grandchildren with college, budget for that. Perhaps your total discretionary spending is another $20,000 per year on top of your $48,000 of essential expenses covered by your income floor. 2 to 3 years of that discretionary spending means $40,000 to $60,000 in your strategic reserve. Add another $20,000 to $30,000 as an emergency fund for unexpected expenses that do not fit neatly into either category. A major home repair like a new roof or HVAC system, an unexpected medical expense not covered by insurance, helping a family member through a financial crisis. These emergencies are unpredictable but inevitable over a long retirement. Your strategic reserve might total somewhere between $60,000 and $100,000, depending on your specific spending patterns and risk tolerance. Some people feel more comfortable with a larger cushion, especially if they're naturally anxious about money or if they have experienced financial hardship in the past. There is nothing wrong with holding slightly more than strictly necessary if it helps you sleep better at night. The strategic reserve serves several critical purposes that reinforce each other. First, and most importantly, it provides a buffer that allows you to avoid selling stocks during market downturns. This single benefit alone can add hundreds of thousands of dollars to your lifetime wealth. When the stock market crashes, and it will crash periodically because crashes are a normal feature of markets, you can draw from your strategic reserve instead of selling stocks at depressed prices. You never become a forced seller. You always have the option to wait for recovery. Your stocks stay invested, participate in the eventual rebound, and your long-term wealth is preserved. Second, the strategic reserve provides psychological comfort that enables good decision-making. Knowing that you have 2 or 3 years of expenses sitting in safe investments gives you the confidence to stay invested in stocks with the rest of your portfolio. This psychological benefit is underrated but enormously important. Fear causes terrible investment decisions. People panic and sell at market bottoms. They lock in losses that permanently impair their retirement security. They swear off stocks forever and miss the subsequent recovery. The strategic reserve short-circuits this destructive emotional cycle by providing a sense of security that makes it easier to stay the course. Third, the strategic reserve provides flexibility for irregular large expenses that are predictable in their occurrence but unpredictable in their timing. You will need a new car eventually, but you do not know exactly when. Your roof will need replacement, but you do not know if that will be next year or 5 years from now. Opportunities to help family members will arise, but you do not know what form they will take. Having liquid savings available means you can handle these situations without disrupting your investment strategy or compromising your income floor. Let me talk about how to manage the strategic reserve over time. When markets are performing well and your investment portfolio is growing, you can replenish the strategic reserve by occasionally selling appreciated stocks and moving the proceeds into safe investments. When markets are performing poorly, you draw down the strategic reserve instead of selling stocks, giving your equity portfolio time to recover. This approach is sometimes called a bucket strategy or a time segmentation strategy. You are essentially dividing your retirement assets into different buckets with different purposes and different time horizons. The income floor covers current essential expenses. The strategic reserve covers near-term discretionary expenses and emergencies, and the remaining assets, which we will discuss in Step 3, provide long-term growth to replenish the strategic reserve and stay ahead of inflation. One mistake people make with the strategic reserve is holding too much in cash and safe investments. If you have 5 or 10 years of expenses sitting in treasury bills, you are sacrificing long-term growth that could dramatically improve your retirement security. Cash feels safe, but over long periods, it loses purchasing power to inflation. The strategic reserve should be sized appropriately, not too small and not too large. 2 to 3 years of discretionary expenses plus an emergency fund is the sweet spot for most retirees. Another mistake is treating the strategic reserve as untouchable. Some people are so afraid of depleting their safe money that they refuse to use it even when that is exactly what it is designed for. If the market drops 30%, that is precisely when you should be drawing from your strategic reserve rather than selling stocks. That is the whole point. Do not defeat the purpose by being too conservative with money that was set aside specifically for this situation. Step 3 is long-term growth through equity ownership. This is where most conventional retirement advice goes terribly wrong. And this is where I am going to tell you something that might surprise you or even alarm you initially. If you are over 60 and in reasonable health with a potentially long retirement ahead of you, you need a significant portion of your portfolio in stocks, not bonds, not annuities, not cash, not certificates of deposit, stocks, ownership of actual businesses. I can hear the objections already. My financial advisor told me to reduce stock exposure as I age. Stocks are too risky for retirees. I cannot afford to lose money at this point in my life. I am too old to wait for the market to recover from a crash. I have heard all of these arguments hundreds of times, and they reflect a fundamental misunderstanding of what risk actually means for retirees. Here is the reality that most people do not grasp. The biggest risk for most retirees is not short-term market volatility. It is not watching your portfolio drop 20 or 30% in a bad year. The biggest risk, the risk that will actually destroy your retirement, is running out of money before you die. It is losing purchasing power to inflation over a 20 or 30-year retirement. It is becoming increasingly poor in real terms year after year as the cost of healthcare and food and housing rises faster than your fixed income. It is watching your standard of living slowly decline until you cannot afford the things that make life worth living. Stocks, properly positioned within the 3-step framework, are the best protection against these truly dangerous long-term risks. They are not the source of risk. They are the antidote to risk. Let me give you some historical perspective that should inform how you think about this decision. Over the past 100 years or so, since we have reliable data, stocks have returned approximately 10% annually on average. That includes every war, every recession, every depression, every financial crisis, every pandemic. Through all of it, American stocks have returned roughly 10% per year over the long term. Bonds have returned approximately 5% over the same period. Cash and treasury bills have returned approximately 3%. And inflation has averaged approximately 3% over the long term, though it has been higher recently and can spike dramatically in certain periods. What do these numbers mean for retirees? They mean that stocks have provided a real return after adjusting for inflation of approximately 7% per year. Bonds have provided a real return of approximately 2% per year. And cash has provided a real return of essentially zero. In fact, during periods of high inflation like we have experienced recently, cash loses purchasing power. You get poorer by holding cash even though the nominal dollar amount stays the same. Over a 20 or 30-year retirement, the differences between these real returns compound into enormous sums that can mean the difference between comfort and poverty. Let me illustrate this with concrete numbers that will show you exactly what is at stake. Take $100,000 and assume you earn 7% real returns by investing in stocks. After 10 years, that $100,000 becomes $197,000 in today's purchasing power. After 20 years, it becomes $387,000. After 30 years, it becomes $761,000, all in inflation-adjusted terms. Your money has grown dramatically in real purchasing power. Take the same $100,000 and assume you earn 2% real returns by investing in bonds. After 10 years, you have $122,000. After 20 years, you have $149,000. After 30 years, you have $181,000. Your money has grown, but barely. The difference between bonds and stocks over 30 years is $580,000 on an original investment of just $100,000. Now take that same $100,000 and assume you earn 0% real returns by holding cash. After 10, 20, and 30 years, you still have approximately $100,000 in purchasing power. You have treaded water. You have not grown your wealth at all. And that is assuming zero real returns. During inflationary periods, you actually lose purchasing power. Your 100,000 might have the buying power of 70 or 80,000 after 30 years of inflation. The difference between 761,000 and 181,000, or between 761,000 and 100,000, is not an abstraction. That difference is the gap between a retirement where you can travel, help your grandchildren, maintain your home, afford quality health care, give to charity, and enjoy life, versus a retirement where you pinch every penny, deny yourself simple pleasures, and worry constantly about whether you will run out of money. This is why I say stocks are not the risk. Avoiding stocks is the risk. By hiding in bonds and cash, you feel safe because you are avoiding visible short-term volatility, but you are guaranteeing invisible long-term decline. You are trading a problem you can see for a problem you cannot see until it is too late. And the problem you cannot see, the slow erosion of purchasing power over decades, is actually the greater danger. Yes, stocks are volatile. Yes, stocks sometimes lose 30 or 40% of their value in a single year. But you are insulated from this volatility by your income floor and your strategic reserve. Your essential expenses are covered by guaranteed income. Your near-term discretionary expenses are covered by safe investments. The money you have in stocks is money you will not need for 5 or 10 or 15 years. You can afford to wait out any market downturn because you are not a forced seller. This is the key insight that transforms the conventional wisdom about retirement investing. Conventional wisdom says reduce stock exposure as you age because you cannot afford short-term losses. But if you have built an income floor and a strategic reserve, short-term losses do not matter. You will not be selling during downturns. You will be waiting for recovery. And history shows that every major market downturn has eventually been followed by a recovery that reached new highs. The worst thing you can do as a retiree with a long time horizon is hide all your money in bonds and cash. You might feel safe in the short term, but you are guaranteeing a slow decline in purchasing power over the long term. You are trading visible short-term risk for invisible long-term risk. And the long-term risk, the risk of outliving your money because your assets did not grow fast enough to keep pace with inflation and withdrawals, is actually the greater danger. How much should you have in stocks? This depends on your specific situation, but for many retirees with properly constructed income floors and strategic reserves, the answer might be 50 to 70% of your remaining investable assets. That might sound aggressive compared to conventional advice, but it is actually conservative when you understand the full picture. Remember, this is money sitting on top of your income floor and strategic reserve. Your essential expenses are already covered. Your near-term needs are already covered. This money exists to provide long-term growth, to replenish the strategic reserve over time, to stay ahead of inflation, and to provide a legacy for your heirs if that is important to you. Growth requires equity ownership. There is no other way. What kind of stock should you own? My advice is the same advice I give to everyone, regardless of age. Own a low-cost, broadly diversified index fund that tracks the overall stock market. An S&P 500 index fund or a total stock market index fund provides exposure to hundreds or thousands of American companies. You own a piece of American business broadly, participating in the growth of the economy over time. Do not try to pick individual stocks. Do not try to time the market. Do not pay expensive fees to fund managers who promise to beat the market, but almost never do consistently. Just own the whole market at the lowest possible cost and hold it for the long term. This approach has beaten the vast majority of professional investors over time, and it will serve you well in retirement. Now let me talk about how to put all 3 steps together into a coherent plan. Start by calculating your essential expenses. Be thorough and honest. Include everything you truly need to maintain a basic standard of living. This is your income floor target. Next, inventory your guaranteed income sources. What will you receive from Social Security at different claiming ages? Do you have any pension income? Any other sources of guaranteed lifetime income? Compare your guaranteed income to your essential expenses target. If there is a gap, consider how you might fill it, possibly with an immediate annuity or by delaying Social Security to increase your benefit. Then determine how much you need in your strategic reserve. Calculate your discretionary expenses and add an emergency fund. This is money that will be invested in safe, liquid assets like treasury bills and money market funds. Finally, Everything else goes into your long-term growth portfolio, primarily invested in low-cost stock index funds. This is the engine that will keep your retirement on track over 20 or 30 years, replenishing your strategic reserve as needed and staying ahead of inflation. Let me walk through a specific example to make this concrete. Suppose you are 65 years old and retiring with $500,000 in savings plus Social Security benefits of $2,500 per month. If you claim now, or $3,500 per month if you wait until 70. Your essential expenses are $4,000 per month or $48,000 per year. Your discretionary expenses are $20,000 per year. Your total spending need is $68,000 per year. If you claim Social Security now at $2,500 per month, you have $30,000 per year in guaranteed income. You need another $18,000 per year to complete your income floor. That might require investing approximately $200,000 in an immediate annuity. That leaves you $300,000. You put $75,000, roughly 2.5 years of discretionary expenses plus emergency funds into your strategic reserve. The remaining $225,000 goes into a stock index fund for long-term growth. Alternatively, you could delay Social Security until 70 and get $3,500 per month or $42,000 per year. That almost completely covers your essential expenses, so you might need only a small immediate annuity or none at all. You could put $100,000 in your strategic reserve and leave $400,000 for long-term growth. The second approach might be better for most people because delaying Social Security is such a powerful strategy. But both approaches follow the same framework. Secure the income floor first, build a strategic reserve second, invest the rest for growth third. Let me address some common concerns and objections. Some people worry that they will die early and waste money on Social Security delay or annuities. This is a valid concern, but it reflects a misunderstanding of the risk you are managing. The goal is not to maximize the expected value of your estate. The goal is to ensure you never run out of money while alive. Dying early with money left over is a much better outcome than living long and running out. You are buying insurance against longevity. And like all insurance, it costs something. The peace of mind and security are worth the price. Some people worry that inflation will erode their income floor over time. This is why Social Security is so valuable, because it adjusts for inflation annually. Immediate annuities typically do not adjust for inflation, which is a real limitation. However, the growth portfolio in Step 3 is designed to stay ahead of inflation over time, providing increasing income to supplement the fixed annuity payments. The combination of inflation-adjusted Social Security, fixed annuity income, and growing equity investments provides better inflation protection than most alternatives. Some people worry that stock market crashes will devastate their retirement, but if you have followed the 3-step plan, crashes will not devastate you. Your essential expenses are covered by guaranteed income that does not depend on market performance. Your near-term discretionary expenses are covered by your strategic reserve. A crash only affects money you will not need for many years, giving you time to wait for recovery. You are insulated from being a forced seller, which is the only way crashes truly devastate retirees. Some people worry that this approach is too complicated to implement, but it is actually quite simple. Step 1 is maximizing Social Security and possibly buying an immediate annuity. Step 2 is putting 2 to 3 years of expenses in Treasury bills. Step 3 is putting the rest in an index fund. That is it. 3 steps. Once you set it up, there is very little ongoing management required. You check in periodically to rebalance and replenish the strategic reserve when markets are strong, but otherwise you leave it alone. Let me share one more story to illustrate how this approach works in practice and why it provides such powerful peace of mind. I know a widow who retired at 67 with $400,000 in savings in Social Security of $2,200 per month. She was terrified of running out of money. Her husband had always handled the finances throughout their 50-year marriage, and she felt completely lost and overwhelmed after his sudden death from a heart attack. She did not know how much money they had, how it was invested, what bills needed to be paid, or how long the money would last. The fear was paralyzing. Her children were worried about her. They saw her becoming increasingly anxious and withdrawn. She was not sleeping. She was not eating properly. She had stopped seeing friends because she felt she could not afford to go to lunch or participate in activities. The financial anxiety was destroying her quality of life, even though, as it turned out, she actually had enough money to live comfortably. We sat down together and walked through the three-step plan systematically. First, we calculated her essential expenses. Her house was paid off, but she still had property taxes, insurance, utilities, food, healthcare costs, and basic transportation. Her essential expenses came to $3,500 per month, or $42,000 per year. Her Social Security covered $2,200 per month, leaving a gap of $1,300 per month, or about $15,600 per year, to complete her income floor. We calculated that a $160,000 immediate annuity from a highly rated insurance company would fill that gap and provide guaranteed income for the rest of her life, no matter how long she lived. That left her with $240,000. We put $60,000 in treasury bills and money market funds as her strategic reserve, enough to cover roughly 3 years of her discretionary expenses, plus a comfortable emergency cushion. The remaining $180,000 went into a total stock market index fund for long-term growth. Her first reaction was fear about having so much money in stocks. She was absolutely convinced the market would crash the next day and she would lose everything. Her husband had always been conservative with money, and the idea of having almost half her remaining savings in stocks felt reckless and dangerous. But we talked through the logic step by step. Her essential expenses, the money she needed to keep a roof over her head and food on the table, were covered for life by Social Security and the annuity. It did not matter what the stock market did. Her basic needs were secure. She could not become destitute or homeless or unable to afford health care, no matter what happened to stocks. Her near-term discretionary expenses, the money for gifts and modest travel and replacing her car eventually, were covered by the strategic reserve. She had 3 years of cushion in safe investments. Even in a severe market crash, she would not need to touch her stocks for years. The money in stocks was truly long-term money, money she would not need for 5 or 10 or 15 years, money that had time to ride out any market downturn and participate in the eventual recovery. History showed that every major crash had been followed by a recovery that reached new highs. Patience was rewarded, panic was punished. Slowly, she began to understand the framework. She saw how the pieces fit together to provide layered protection. The income floor gave her security for necessities. The strategic reserve gave her flexibility for discretionary spending. The stocks gave her growth to stay ahead of inflation and maintain her purchasing power over what could be a 25 or 30-year retirement. For the first time since her husband died, she felt confident about her financial future. She started sleeping better. She started seeing friends again. She stopped obsessing over every purchase. The constant background anxiety that had been poisoning her life began to fade. That was 8 years ago. During those 8 years, the stock market has had significant ups and downs, including a dramatic crash during the pandemic in March of 2020, when stocks fell over 30% in a matter of weeks. The headlines were apocalyptic. Experts were predicting depression. Her friends who watched financial news were panicking and selling everything. But she did not panic. She drew from her strategic reserve to cover her discretionary expenses instead of selling stocks. Her essential expenses continued to be covered by Social Security and her annuity regardless of what the market did. She waited. The market recovered within months. Her stock portfolio recovered and then continued growing. Today, at 75 years old, her total portfolio is worth more than when she started her retirement, despite 8 years of withdrawals for living expenses. The growth from her stock investments has more than offset her spending. She is in better financial shape than she was at 67, and she has complete peace of mind about her future. She no longer fears running out of money because she understands the system protecting her. Her children are amazed at the transformation. The frightened, anxious widow who could not make financial decisions has become a confident woman who understands her money and knows she will be okay. She recently helped one of her grandchildren with a down payment on a first home, something she never would have imagined being able to do when she was consumed by financial fear. That is the power of the three-step plan. It provides both security and growth. It protects against short-term volatility and long-term inflation simultaneously. It eliminates the debilitating fear of running out of money while preserving and even increasing wealth over time. If you are over 60 and worried about your retirement, I urge you to implement this plan as soon as possible. Do not wait. Do not procrastinate. Do not convince yourself you will get to it next month or next year. Every year you wait is potentially a year of higher Social Security benefits you sacrifice by claiming earlier than optimal. Every year you wait is a year of compound growth you miss out on. Every year you wait is another year of unnecessary financial anxiety, diminishing your enjoyment of what should be a wonderful time of life. Start today, right now. Calculate your essential expenses, evaluate your Social Security claiming options, and seriously consider delaying as long as possible. Consider whether an immediate annuity makes sense for filling any remaining gap in your income floor. Build your strategic reserve with 2 to 3 years of discretionary expenses in safe investments. Invest everything else in low-cost stock index funds and commit to leaving it alone for the long term. Follow these 3 steps faithfully, and you will never run out of money. You will have the unshakable security of guaranteed income covering your essential expenses. You will have the flexibility of a strategic reserve for discretionary spending and unexpected emergencies. And you will have the growth potential of equity ownership to stay ahead of inflation, replenish your reserve over time, and potentially leave a legacy for your children and grandchildren if that matters to you. This is not a get-rich-quick scheme. This is not a promise of spectacular returns or effortless wealth. This is a practical, mathematically sound, time-tested approach to ensuring that your money lasts as long as you do. It has worked for countless retirees who came before you, and it will work for you too if you have the discipline to implement it and the patience to stick with it through the inevitable ups and downs. The fear of running out of money is real and valid. I understand it completely. But that fear does not have to control your retirement or diminish your quality of life. With the right plan, carefully implemented, that fear can be replaced by confidence and peace of mind. The 3-step plan I have shared with you today provides that confidence. It provides that peace of mind, and it provides the financial security you have earned and deserve after a lifetime of hard work and diligent saving. Take action now. Your future self, enjoying a secure and comfortable retirement 20 years from now, will be profoundly grateful for the wisdom and discipline you demonstrated today. And you will never again have to lie awake at night wondering whether your money will last. Because with this plan, faithfully executed, it will last. I am certain of it.